Understanding legislative risk, an in-depth analysis. Legislative risk refers to the potential that government actions, including new regulations or changes in the law, may significantly impact the business prospects of specific companies or entire industries. This risk can adversely affect an investor's portfolio, as alterations in legislation can dramatically reshape demand patterns, operational rules, and the overall economic environment in which a business operates. The complex relationship between legislation and business. The intertwining of government actions and business operations highlights the inherent uncertainty businesses face in a regulated environment. Companies often rely on predictable legislation to make informed decisions regarding investments, hiring, and product development. However, sudden changes in laws, whether they be regulation, taxation, or subsidization, can lead to unforeseeable consequences. Key takeaways. Impact on demand. Changes in regulations can limit a company's ability to service its customer base, resulting in a diminished market share or profit margins. Investor hesitancy. Increased regulation and taxation may deter potential investors, as they often seek stable and predictable environments in which to place their capital. Regulatory oversight. Governments typically intervene to protect public interests, especially when businesses are seen as unable or unwilling to self-regulate. However, excessive regulation can stifle innovation and operational efficiency. Theoretical framework behind legislative risk. The government acts as a facilitator between public welfare and business interests. In theory, this buffer supports fair competition and consumer safety. However, the reality often reflects excessive legislative measures which serve to elevate the government's role, frequently more for political gain than actual need. This scenario creates an environment of heightened legislative risk that businesses must navigate. Legislative risk varies across sectors, with certain industries facing greater exposure due to their dependency on government policies. Industries such as healthcare, energy, and finance are particularly vulnerable, owing to their regulatory-heavy nature. Examples of legislative risk in the real world. 1. The healthcare industry. The healthcare sector exemplifies high legislative risk. Companies that produce pharmaceuticals or provide healthcare services must navigate a maze of regulations concerning Medicare, insurance coverage, and patient privacy laws. Changes in policies regarding drug pricing, insurance reimbursement rates, or healthcare delivery systems can dramatically affect profitability and operational strategy. 2. Retail industry. Case study of Walmart. Walmart Stores Incorporated serves as a relevant case study for understanding legislative risk in retail. In its annual 10-K filing with the Securities and Exchange Commission, SEC, Walmart highlighted numerous political and legislative risks that could impact its operations. Key risk areas include political instability. Fluctuating political climates can create uncertainty in operational strategies, particularly for international operations. Legal and regulatory constraints. Strictures such as local product safety standards, labor laws, and environmental regulations can hinder business agility. Tax regulations. Changes in taxation not only affect bottom-line profitability but also complicate financial forecasting. Trade policies and tariffs. Foreign trade policies and tariffs can add to operational complexity for companies reliant on international supply chains. In particular, Walmart mentions complexities associated with laws in countries like Brazil and China, where regulatory environments can shift quickly and unpredictably. Conclusion: navigating legislative risk. Investors and businesses alike must account for legislative risk when assessing potential investments and operational strategies. Understanding the dynamics between government actions and business implications can lend businesses a strategic advantage in mitigating risks associated with sudden legislative changes. As global economies continue to shift, the importance of comprehending legislative risk cannot be overstated. Companies that are proactive in monitoring and adapting to legislative environments will not only protect their investments but should also position themselves at the forefront of market volatility and opportunity. Managing legislative risk is ultimately about strategic foresight, preparation, and the ability to quickly adapt to new regulatory realities. Businesses and investors who recognize this can better navigate the complex relationship between legislation and competitive viability.